This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices lower in the overnight trade. This linked to weaker than expected economic reports this morning, at least on balance weaker than anticipated numbers. Also, we did have the European Commission downgrading the economic growth forecast for the Eurozone. However, we do feel that interest rates will remain extremely low for a very long period of time, much lower and longer than most analysts are anticipating. So even though we did have some weak economic news in the overnight trade, I think we can see a move to higher on the day in stock indices. In fact, it was just yesterday that we did see the S&P advancing to new highs for the move in the December contract. So nothing really changing in our long-term view for stock index futures. The main trend still appears to be higher and is likely to be led and fueled by lower interest rates. Over in the currencies, we are seeing some short covering coming into the euro currency, even though we did have the European Commission downgrading the outlook for the Eurozone economic situation. Also, we are seeing some short covering coming into the yen after 2 days of severe declines. On Friday, the Bank of Japan expanded their asset purchase program, which came as a surprise. At least the timing came as a surprise, not the actual event. And also we are seeing some gains in the British pound with the European Commission upgrading the outlook for the UK economy. Still feeling though that interest rate differentials are likely to converge. Even the Fed, that has been hawkish for quite some time, seems to be talking back their hawkish tone as of about a week and a half ago at the release of their recent Fed minutes. So still looking for major breakouts not to follow through in either direction, especially for the US dollar, which I think is very close to a top in here now. Interest rate markets holding up very well and should be supported long-term by prospects of more accommodation from the world's central banks. Even the ECB, which is likely to not change policies at their Thursday meeting, I think will ultimately add more economic stimulus at following meetings. So the global interest rate environment is very accommodative and is likely to become even more accommodative this year and well into next year, which is very supportive to Treasuries. So still thinking the main trend is higher for the interest rate futures markets, especially at the long end of the curve. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.